Good afternoon, everyone, and welcome to Prestige Wealth Management Group's second quarter 2024 economic and financial markets update. On today's webcast, you're going to hear from Prestige Wealth Management Group's CEO, Roy Williams, Senior Portfolio Manager, Paul Esposito, our Director of Financial Planning, Jeffrey Spivak, and myself, Wealth Advisor Michael Williams. Just a couple of housekeeping items before we get started. Please remember, we are not able to take any live questions during today's webcast, but if you do have any questions, please feel free to reach out to us at pwm@prestigewmg.com, and we'll be sure to get back to you. And please note, we will send you a recording of today's webcast after it is concluded, so be on the lookout for that. And with that, I'll pass it over to Paul Esposito to get us started.
Thank you very much, Michael. Good afternoon, everyone. Thank you very much for joining us. Here's just a quick state of the agenda for our webinar today. Of course, Jeff is going to be talking about some tax planning opportunities for this year and next year with some of the looming tax law changes, just to add to the format. But if we look at the second quarter, just to provide a summary of it, there wasn't much difference in how it unfolded compared to the first quarter. So the S&P and the NASDAQ, of course, made new highs with the trend in artificial intelligence really driving market returns for the quarter. Really no different than the trend that we saw in equities for the first quarter. Market breadth, again, with very narrow leadership, was lacking for the quarter. Growth stocks, of course, took the lead, while value stocks considered to lagged considerably, which is very evident in the Dow Jones Industrial Average. So that index did make a new all-time high at the beginning of the quarter, but it failed to hold on to those and actually ended the quarter slightly lower, just because of its constituents having more value stocks, and of course it being a price-weighted and not a value or market cap-weighted index. There is a very similar dichotomy that unfolded in both the small and mid-cap realm for the equity markets. Both of those segments actually posted negative returns for the quarter. And, if you look at the double-digit returns of the broad market for the year, I mean, those two segments of the market were barely positive. And we'll go into detail as to why that trend is in existence, and what the risks are for maybe a reversion later on this year. The bond market, on the other hand, is essentially unchanged. I think investors are awaiting news about inflation and the Fed's rate cut policy. So that holding pattern makes sense, but nevertheless, if you look at starting yields on the bond market, they now they ended the quarter at about 5%, so that's very attractive from an historical standpoint. It's been roughly a year since the Fed stopped hiking rates to fight inflation, and it certainly looks like the Fed is now closer to achieving their goal of getting inflation under control, as per the recent inflation readings, which we'll go into in a minute. However, the Fed is now posturing toward a rate cut later this year, which may be a response to some of the economic conditions tightening for consumers, and that's evidenced by some of the job losses that we've seen with today's figures. And there's overall signs that we've seen, at least on the surface, that growth may be cooling. So, if we recall, the Fed has two mandates. One is price control, or to control inflation, and the other one is to maximize the employment picture. So trying to strike a balance becomes a very interesting task for them this late in the game. So in looking at economic growth expectations for this second quarter, we won't get those actual GDP readings until later this month. This is a chart from the Atlanta Fed. They have a reading called GDP Now, which takes into consideration, all of the components that make up GDP, from consumer spending, net exports, government spending, non-residential and residential spending, as well as private investment. And For the last, I'd say at least few quarterly readings that we've seen with the Atlanta GDP, it's always started out fairly high, and then obviously as the data comes in throughout the quarter, they start ratcheting down their estimates. When they started reporting this estimate in late April, it was at around 4%. But then toward late May, there was actually a broad decline in consumer spending, along with a decline in net exports of about 1%, which caused an initial ratchet down farther. The same thing ensued in May, and right now the growth expectations for the second quarter sit at around 2.7%. That's a real GDP growth number, and as I said, those drops in the estimate were, namely due to consumer spending and net exports dropping, which, again, given the fact that interest rates are as high as they are, that certainly is the leading cause as to why the consumer may be, showing some signs of fatigue. Interestingly enough, if you look at some trends in both credit card delinquencies and auto loan delinquencies, obviously credit card balances are, at historically high levels. That is obviously probably, contributing to debt woes for the consumer base. And then also high interest rates with auto loans, both, new and used, mostly on the used front, are certainly making, a lot, record high auto loan notes very difficult for consumers to service. So again, nothing, I would say, imminent, but there are just some concerns that we have with the state of the consumer. And looking at the unemployment rate, obviously unemployment is still at a record low at 4.1% to end June. Total non-farm payrolls increased in June to about 206,000. But if you look at where most of the gains came from, same cast of characters. It came primarily from government employment, job gains, healthcare, social assistance, and of course the construction industry. But if you look at the total number of unemployed, we're sitting at 6.8 million. So, a 4.1% rate of unemployment for that 6.8 million doesn't seem all that bad. But if we kind of look at where the jobless rate was a year ago, we were sitting at 3.6% and 6 million unemployed. So there has been an uptick in unemployment. Again, it's by the Fed standards, that's still full employment. But again, the trend is sort of heading, in the direction that the Fed probably doesn't want to see unfold, or at least worsen. Wage growth, on the other hand, is staying right near the 50-year average at about 4%. That's certainly a good sign as inflation slows down, driving workers, or at least giving workers some time to catch up on inflation. But the rise in unemployment certainly suggests that the labor market is less robust than it was at least 1 to 2 years ago. And this is certainly corroborated by labor demand. So if you look at the JOLTS survey, it's a job openings and labor turnover survey. Going back to March of 22, we had over 12 million available jobs. That number has dropped precipitously, over the last couple of years. We now sit at just over 8 million available jobs, which is still very robust, but again, giving workers that are seeking employment less options as they had a year or 2 years ago. That number still sits slightly above where it was during or pre-pandemic levels. But then if you look at the quit rate at the upper right hand side, you're noticing that workers are not quitting as much. So again, this is really just pointing to less optionality for the labor force. So that could be putting, some pressure on the labor market. And of course, in looking at layoffs are still very historically low. They're still well below the pre-pandemic trend. But off of the low that we saw in 21, we are starting to see a noticeable pattern, noticeable uptick there. Inflation has come in, the first quarter. I think the Fed's guidance was disrupted by some of the unnecessary inflation that we saw. But the trend in inflation is certainly, starting to weaken. And with that, I'm going to hand this over to Roy to actually go a little bit more in detail with the status of inflation.
Yeah, in terms of inflation, we're seeing the Fed's goal is to get to 2% inflation. And month over month, this past month, it was a negative 0.1, which is just showing favorable signs. And listening to the head of the Federal Reserve, he's optimistic that, and we'll talk about rate cuts later, but, we'll be able to cut rates and we're heading in the right direction. Maybe in the wrong direction for unemployment, which is the right direction for the Fed's cutting rates. The Swiss and Canada have already cut rates 0.25%, and Europe is talking about in the next quarter cutting rates 0.25%, and the U.S. will most likely follow suit, which I'll talk about in a second. So when we look at these numbers, compared to last year, you saw a lot of red still. Red is bad as always. So, now you're seeing more of the inflation rates getting into, the target rates that we want them to be. Clients, I still hear from clients, about inflation, that the cost of food is still going up significantly, or the cost of, one client took a cruise last year and they looked at the same cruise this year. They just, I guess, got an advertisement. It was 30% more for the same week, same cruise that they did. It was 30% higher. So depending upon what you're doing and where you're spending your money, inflation is real. And let's look at really, what makes up inflation. We're looking at, shelter is a big part of that. Rents have continued to increase exponentially, but one good sign is that inventories for housing has increased. Paul and I were talking about this earlier in the week, that we're, again, depending upon the state and the town where you're in, if you're in a half-hour train ride of New York City, it's a hotter real estate market, and you have less inventory than if you're in the suburbs significantly outside the city, no matter what state you're in. But we're seeing inventories increase, and the Fed, wants to cut rates because the mortgage rates are, you're looking at 6.5% to 7%. So actually, they've been fluctuating between 6.5% and 7.5%. One thing on here, you see auto insurance. Auto insurance has gone up, with labor costs going up and everything going up. You've seen a significant increase. What's not on this is homeowners insurance. Homeowners insurance, depending upon what state you're in, we're looking at 15 to 30% increases on homeowners insurance, which is significant. So, the numbers, when we look at inflation, you always have to remember the Fed's looking year over year, but not looking at the past 4 years. Or, a lot of people remember when they paid 50 cents for a container of yogurt, which now is $1.29 for the same container of yogurt. So they're really looking at year over year. And there are some areas such as wood, plywood's come down. Certain commodities have come down, which is helping inflation. The consumer sentiment, is a indicator we look at. Consumers, there's a lot of uncertainty out there. This is an election year, which creates some uncertainty, obviously. And, the Fed, will they or won't they decrease rates? When will they decrease rates? So, that adds to some of the uncertainty and, with consumer sentiment. But we're seeing people, we're seeing clients travel. We're seeing clients spend money buying cars, whatever they're doing. We're seeing clients spend money. So, that's favorable as we go forward and will help the economy. Fed and interest rates, I'm going to show you two charts. This is looking at last quarter. There was a 61% chance of a rate cut, having a rate cut in September. Now that has increased significantly to where it's at over 90% that the Fed's going to cut rates in September. And again, with the inflation print that came out month May to June, that was favorable. And with a little spike of unemployment, that is favorable for the Fed to move forward with rate cuts. Again, by them cutting rates, that will help the economy move forward and, help housing, help credit card interest rates. It'll help a lot of things within the economy by them cutting rates. So I think it's favorable. The economy was at very low rates for so long. I think it's tough to absorb 6.5%, 7% rates, whether you're leasing a car, whether you're renting. So the Fed needs to cut rates, and hopefully they get to a target rate closer to 4 eventually. With that, Michael will take over and talk about the markets.
Yeah, thanks. So just continuing the conversation about the potential for rate cuts from the Fed, one of the impacts that's had on the markets is that the stock market continues to grind higher throughout the quarter. And one of the things that we're hearing from clients consistently is there's almost this feeling like things are almost too good. There has to be a correction or a little bit of a pullback. And, we do believe that pullbacks are a healthy part of the market, but not necessarily a crash or result of the market just becoming too overheated. So one of the things that we looked at is that the S&P 500 overall is trading at a 21.4 times its forward earnings. And of that, the top 10 stocks are trading at 33.7 times. And that is objectively a higher concentration than it has been historically. But some of that is the people looking at the potential for Fed cuts in the future. And some of that is also the discounting of the future prospects of artificial intelligence. A lot of those top 10 companies are beneficiaries of artificial intelligence, and their earnings are kind of showing as a result. A good example of that is, one of the top 10 companies, NVIDIA's earnings that were up over 100% from the previous year in the most recent quarter. But again, just because those stocks themselves are trading a little rich compared to the markets, we don't necessarily see there's always a corollary to the dot-com bubble bursting. We don't see anything like that on the horizon, but we do see, potential for a little bit of a rotation from some of these growth stocks. Some of these stocks are kind of, their valuations are getting stretched. But just as put it in perspective, during the 2000 bubble, Cisco, which was kind of the darling of that market, that was trading at 131 times the forward earnings, whereas one of the darlings, NVIDIA today, is only trading around 45. So we're not really to the point where things are getting that stretched, but we do see the potential for, rotation from some of these growth stocks to some of these value-oriented stocks. And just to highlight what I mentioned earlier, is the difference between some of these stocks from the 2000s. If you look at the actual earning contributions of these, they were not really that high compared to where their stock prices were. Whereas today, those companies, the top 10 companies, are very profitable, right? So they're almost 25%, but they are trading at a little bit of a premium to the overall market. So we do see, when we're looking at the difference of the price to earnings multiple, the remaining stocks outside of the top 10 are only trading at a 17 times multiple, which is a lot closer to the overall average of S&P 500 being 16.6. So what does that lead to for us as an investment policy committee? And one of the things that we stress to clients is the importance of staying diversified, right? Diversification is not something sexy. It's not something that's going to get you on the front page of the Wall Street Journal or on CNBC, but we really do believe it is very fundamental. It's the reason that we don't kind of pile into these stocks as they start to continue to get overheated. But this shows just a chart of historical returns from the S&P 500 from the early 90s to today. And as you can see, one of the interesting things that I always point out is the average return since then is 9.7%. But one of the things you'll notice is that it is very rare that the actual return of the market is close to this average, right? There's either years where the markets are knocking the cover off the ball or their markets are down quite a bit. So there's an importance of staying diversified in order to actually achieve, oh, my apologies. Go back, sorry, Paul. To achieve this average is staying diversified. Next one. And one of the things that is important to highlight is even in a good year. So a good year, meaning last year where the markets were up close to 20% on average, of the S&P 500, there were still 126 companies that were down over 5%, right? So each of these companies are going to have their day in the sun, and there's a reason that we, obviously it's a good thing when these stocks do go up. But it's important not to get overly concentrated in them because there are times where those stocks aren't going to perform, and we don't want to have the whole portfolio go down there with it. So when we look at the fixed income dynamics, again, talking about having this day in the sun, fixed income has kind of been in this kind of holding period where, a lot of bond managers are waiting for when the Federal Reserve decides to cut rates. And I think we have a little bit more certainty now about kind of when and what that's going to look like. With the prospect of a 25 basis point cut coming in September that we talked about. But overall, I mean, the bonds have still kind of lagged a little bit. But one of the things that we are stressing to our clients, and some of our clients have kind of got overly excited about the prospect of 5% rates of return on their cash, which is objectively a good thing. But we've been stressing clients is not to get married to that. Remember that when the Fed does cut rates and when rates do reprice, those high rates of return on your savings accounts are probably going to go down there with it. So we are recommending to clients that if you are kind of really heavy into cash, to consider going into the diversified bond portfolio because bonds have a difference between bonds and cash is bonds do get a price appreciation or an increase in price as rates do decline. So as the Fed starts to cut rates, we see a normalization of the interest rate curve. There's going to be a price increase on some of these bonds. So we are looking forward to bonds having a decent return again. And, right now they are yielding a decent amount. So we're excited about that. Go ahead. Just to kind of highlight what I mentioned earlier about the forward rate of returns of bonds. Right now, the forward yield of bonds for the next 5 years anticipated to be close to 5%, right? So if you put that in perspective, a historical perspective, that's not too far off from the historical average. And it's important to highlight. I know that we've had a couple good years of really strong market returns, but those are abnormal. 5% return on a bond is not abnormally good or abnormally bad. It's right there, and we feel pretty good about it. So it's something that we are anticipating and looking forward to in the future. So with that, I'm going to pass it over to Jeff to talk through some financial planning.
Yeah, hi, good afternoon, everybody. For those of you who I have not had the opportunity to meet, I am the new director of financial planning, and this is my first quarterly call. So I'm very excited. I'm coming in at what I think is a really good time. And when I was talking with my colleagues about what to talk about for a quarterly call, I said, talk about what's on your mind. So I thought about it. I said, it's still a little early to talk about year-end tax planning. And it's really early to talk about your beginning for 2025 tax planning. So instead, I decided to throw the whole thing out the window and talk about planning for the year 2026. As you may or may not be aware, the Tax Cut and Jobs Act of 2017 is due to expire at the end of next year. Now, not all provisions will be expiring, but many of them will, and many of them are going to have an impact. The good news is it probably won't impact on you unless you're an individual or a business owner or have an estate plan. As long as you're none of those three people, there probably won't be much of an impact. But having said that, if you are any of those three, this is something for us to talk towards. Now, it may feel a little bit self-serving. My recommendation to you, to your loved ones, to the people that come to you and that you talk about, is go get good advice. We give good advice here, both the tax side as well as the financial planning side. But if you were talking to other people, let them know that this is the time. The reason is, what is actually changing? Well, we've got a lot of things changing. The first one of which is individual tax rates are going to be changing and effectively going higher. We're going to see 50% decreases in both the standard deduction, the estate, and the gift tax exemptions, which means for the first time in years, we are going to have to do effective estate planning. And what's more, the estate plans that have been put in place the last couple of years are probably going to need to be looked at closely, possibly even changing. We're looking at changes to the itemized deduction schedule. And for an awful lot of people, because the standard deduction has been so high, they've never come close to having to itemize their deductions. They've never had to come close to itemizing their deductions. That's probably going to have to change. For some people, starting in 2026, they're going to have to learn how to itemize the deductions all over again. There's changes to alternative minimum tax. There's the elimination of what we call the SALT cap, the state and local tax cap, a return of personal exemptions. And all of this is translating over to a renewed need to look at your financial and estate plans. If you have done plans with us recently, you're aware of the conversations that we're having around this expiration cycle. You know, some of it's going to prompt the need to reexamine the wills and trusts and any gifting programs that you may have in place. We're excited to be able to work with you on it. But it's important that we think about doing this sooner rather than later. One of the rationales to doing it sooner, and this goes back to my earliest statement today, the reason I'm talking about it now, if we need to make changes and some of those changes come at a cost, it's better to pay that cost over 2 years, 2024 and 2025, instead of having to force it all into 1 year. Sooner is better than later. Planned is better than unplanned. Aware is better than not aware. So the things I'm talking towards today are these. Number one, we have to focus and plan for what we know. What we know is that absent the ability for a bipartisan solution sometime in the next 2 years, this is going to expire. It's going to take proactive action on the legislature to prevent it from expiring. And we're probably going to need to see agreement between, all the houses, Congress, White House. I don't know how that's going to happen or if that's going to happen. And if it doesn't, this is going to become important. So what I want us to focus on, we're going to focus for what we know. As new information comes in, we will adjust. I want to underline the importance of making sure that your integrated plans are up to date. Make sure that you're aligning your financial, your tax, and legal advice. Across those information streams, let us work with you and your other advisors to your benefit. And to me, I'm looking forward very much to working with each and every one of you. And with that, that kind of concludes what it is I have to say today. So I'll take it back.
So we want to thank everyone for joining us today. Just as a reminder, if you guys do have questions, you can send them in to pwm@prestigewmg.com. We do have one that came in prior to the call, so we're going to address that now. I'm going to pass it over to Roy to take care of that question.
So the question is, what will the investment landscape look like following the inevitable collapse or sell-off of the Mag 7? Michael touched on it before, and Paul, what most likely will happen, there'll be a rotation into value stocks when the Fed cuts rates. Normally financials do well, healthcare. So there'll be, a rotation into other types of stocks from the Mag 7. It may not be a collapse, but corrections are healthy. We very well could have a correction and then a rally. Or from here, the stocks may not go up for the next, the Mag 7 possibly could not go up for the next 12 months. So then the PE ratio comes down significantly because there wasn't a lot of appreciation. So again, it's very difficult to predict. Again, this year has been a rally in the Mag 7. It was a Mag 5 for a while, but back to the Mag 7.
Roy, I think yesterday was an excellent testament to the potential for a continued turnover trend or rotation trend into value stocks. So if you looked at the Russell 3000 or the S&P 500 was lowered by more than 1% yesterday. Of course, technology stocks, your chip makers, NVIDIAs, the Broadcoms of the world were down mid-single digits. All the other tech companies and darlings, even the communication services companies, were down anywhere from 3 to 5%. But the bastions of stability there were healthcare, consumer staple stocks. Those are deep value. Financials were positive. Almost, small cap was positive. So you have a lot of value-oriented companies that are, filling in that gap. And there is a possibility where you could see a clustered correction in technology, and market returns go nowhere, where the value component of the market sort of picks up the slack of any type of correction that we get in the tech space, or in particular, this case, the Mag 7.
Yeah. One other thing I want to mention on a different topic is taxes, right? Jeff touched on it in terms of the sunset, but a lot of clients were surprised that they had to pay. Individuals who have a significant amount in CDs and savings were very surprised last year that they had to pay more taxes. And this year it will be the same situation, because the Fed stopped increasing rates last year, and some people have locked in a lot higher rates, as the year went on this year. And again, if you earn more interest, you're going to have to pay more taxes on that interest. So I just want to make you aware that when you come in for your tax planning, take a look at, if you have money outside in CDs or savings, what kind of interest you're earning, to make sure we have a good number to do the proper tax planning for you and give you a good number. With that, I'm going to turn it back to Michael.
Yeah, we just want to thank everyone for joining us today. Just as a reminder, we will be sending out a replay of today's webcast, so be on the lookout for that. And with that, we hope everyone enjoys the rest of their summer, and we'll talk to you guys in the fall. Thank you.